All right. Morning, everybody. Welcome to the Living Annuity webinar. I'm Nick Brummer, the founder of Investonline, and joining me is my fellow director, Stuart Dyer. Stuart's going to be doing the presentation. I'll chip in every now and again. Just a bit about Investonline. Investonline is a financial planning business registered with the FSCA. I'm a member of the South African Institute of Chartered Accountants, and Stuart's a member of the Financial Planning Institute. He's a certified financial planner. We operate out of Newlands, Cape Town. We're a team of 13, 9 professionals and 4 admin. The name Investonline is from the original concept of providing a more efficient and effective service. And we certainly feel that it's more cost effective, but even more efficient in terms of time that we spend with our clients. We are a highly qualified, experienced team that provides independent financial planning and financial advice. All right, that's really all from me for now. Stuart, yeah, over to you.
Thanks, Nick. Welcome, everyone. Thanks for joining. Today we're going to be talking about living annuities. Just want to get the slides up here. So just to go through the agenda, we're going to cover how living annuities work, how to invest in a living annuity. Once you're invested in a living annuity and you have that investment, what are the underlying investment options in a living annuity? I think what's an area where there's quite a lot of uncertainty amongst the investors is the difference between pre-retirement funds and a post-retirement fund, or like a pension, such as a living annuity. How to draw sustainable income when you are retired. Some tax and estate planning aspects of retirement and living annuities in particular. And I think we're going to end off with just general financial planning things to know about, little tips and techniques that we would just like to highlight for the audience. We don't have a live Q&A, just time-wise. We're just going to be presenting for around 20 minutes. And then I know Nick's got a few questions that were submitted beforehand that were pre-selected that we're going to go through. So I think there'll be 3 or 4 questions at the end. So what is a living annuity? And a living annuity is really just a type of investment vehicle or type of investment account. It's designed to provide individual investors with regular retirement income. It is an investment or market-linked type of vehicle. So what that means is it's linked to the performance of an underlying asset or basket of assets. We'll go through the different investment options in 2 slides, but basically the performance and the return you get will be linked to whatever you choose to invest into. In terms of living annuity income rules, it is mandatory to draw an income. So this is meant to be a sort of a pension vehicle where it gives you money that you're going to be withdrawing from the portfolio or from the account. The current rules is that you have to take a minimum of 2.5% of the value of the investment per year. So if you've got a 10 million rand investment, you have to take at least an annual income of like 250,000 rand. There's a maximum amount of 17.5%. So you can't just withdraw your whole living annuity in one go or make a big lump sum withdrawal. Over and above 17.5%. 17.5% is the maximum you're allowed to draw per year. You can elect whether you would like to receive your income monthly, quarterly, half yearly, or annually. So you can make that election. And you can also say how much income you would like to get. So within that band of 2.5 to 17.5%, each year you are able to say how much you would like to get, either as a percentage or in rands. And that decision, both of those decisions, the frequency and the amount, that you can change on what's called your anniversary date, which will occur once per year. And I think the one thing to be aware of is that the income is fully taxable. So it's just like a salary, it's taxable, and you receive the after-tax amount in your bank account. So how to invest in a living annuity? The most common way is through a compulsory purchase. So that's any ordinary investor who's got a pre-retirement fund or a mix of pre-retirement funds. An example of a pre-retirement fund would be a retirement annuity, a pension or provident fund, or preservation fund. So when you get to either you leave your employer and retire, or if it's in the case of a retirement annuity or preservation fund, you turn the age of 55. You don't have to do it at age 55, but anytime after age 55, you're able to then retire from the fund and you can move that money into a living annuity. You are able to also do a voluntary purchase, which is where you would be taking accessible money or discretionary savings, and you can put that into a living annuity. So it doesn't have to be only from compulsory money that you've saved up in, let's say, for instance, in a pension fund for a long time. You can now, and it's generally can be a good tool if someone has been a business owner that sold a business or sold properties, and now they've got a lot of cash, but they don't have any formal retirement funds. It can be a good idea to put some money in a living annuity. So what are the investment options in a living annuity? I mean, it's pretty much a normal investment account. It is a rand-based account. So you'll see your investment in rands, and you will, obviously be drawing your income in rands, but the underlying investment universe is very wide. So you can invest into aggressive funds like local or offshore equity funds offshore in the stock market. You can invest into what's called multi-asset funds. So those are funds that invest into a mixture of assets like the stock markets, money markets, and bonds, commonly known names of stable funds and balanced funds. And if you are a more conservative investor, you can invest into income funds or money market funds. So the range of investments is quite wide. There's no, real restrictions. You do have flexibility to switch your investment portfolio. So within the living annuity, you can switch from fund to fund or portfolio to portfolio. There's generally no cost to do that, and there's no tax implications to do that. And this is just an area we want to clear up. I know there's been 1 or 2 articles going around in the industry, as well as a lot of uncertainty with investors is, what are the offshore restriction rules for a living annuity investment? So to be clear, from the government side and the Long-Term Insurance Act side, there are no restrictions on offshore exposure in a living annuity. So it's not required to be Regulation 28 compliant the same way that pre-retirement funds do. You can invest up to 100% of a living annuity offshore. And we've got certain investors, and especially if you spend a lot of time out of the country or you have immigrated now, where you don't want your money in rands, even though your withdrawals will still come in rands, you want your underlying investment to be offshore, you can do that. Some investment companies have reached their own institutional offshore exposure. So some companies have put in their own restrictions where they are capping offshore exposure, for an example, at 40% or 45%. But that's not a government rule. That would be that investment institution's own rule for their investors. So just to compare, the pre-retirement fund, which would be I'm now saving for retirement, I have a pension fund or provident fund at work, or I have a retirement annuity or preservation fund, to a living annuity. So right now, in terms of accessing that money, generally a pre-retirement fund is pretty inaccessible. There is new legislation that's been passed where the 2-pot system is going to come in September. So if you are still saving for retirement, you will be able to access some of your fund from September onwards, and there's quite complex rules around that, but basically everyone's retirement funds is going to have what's called a little savings pot in it that is accessible. But right now, generally, you can't access retirement annuities and pension funds unless you are retiring from those funds. As I said earlier, living annuity, you do have to draw an income. Pre-retirement funds are restricted to Regulation 28 rules, where living annuity is not. The offshore exposure being capped at 45% for pre-retirement funds compared to no cap for a living annuity. Both types of funds do allow beneficiary nomination, but there is a difference in the handling of those beneficiary nominations, and the one big difference being trustee discretion. What discretion do the trustees of the fund have to overrule your beneficiary nomination? And I'll talk a little bit more about that later. Okay, so for those who are close to retirement or already in retirement, obviously a big thing when you've invested, you're now living off of your money and you're drawing from your investments regularly, is to have an idea of, what is a reasonable drawdown or withdrawal that you can take that's going to be sustainable to generally last your lifetime and maybe leave some additional money to your beneficiaries or loved ones. So what we've done is we've just done a real guideline using our models. What I will say is each person's retirement plan is very individual. So this won't necessarily apply exactly like this for everybody. But just as a guideline, what we've done is to say if you had to earn an investment return of 9% per year after fees, and you had to have inflation of 6%. So ultimately, your expenses would go up on an average of 6% per annum. If you wanted your money to last a certain number of years, what sort of percentage could you draw from your investment to be able to have your money last that length of time and have the income be sustainable for that length of time? So that's the important thing, is that income being able to keep up with your spending that's going to be going up. So if we just look at the top line and we say, let's say you were the age of 55 now, and you want your money to still last until your age of 90, then you've got about 35 years that you're planning for. So we've worked that out to be, if you want your income to be sustainable for that amount of time, you would be drawing around 4% or 4.2% of your investment value per year, which works out to monthly income of around 3,500 Rand per million. If we just had to go down and say 30 years, that would be around 4.5%, 25 years, 4.9%, 20 years, 5.5%, 15 years, just over 6%, and 10 years, you could draw almost 8% per year, and your income would be sustainable. And you can just see the corresponding Rand values per million. So a good way to calculate it, if you've got 5 million Rand, you just take the sort of Rand value on the screen and you times it by 5, and that would be a good estimate of what you would be able to withdraw from the fund per month. So we've just got a good chart, and we're going to spend some time going over this chart, is to illustrate this concept. So what we have here is a living annuity. It's a classic, what's called a whale graph. It looks like the top of a whale coming out of the ocean. So on the left-hand axis, we've got the investment value. In this case, we've got, let's say, a living annuity value of 10 million Rand to start with. On the bottom axis, we've got the age. So in this case, we've just said someone who's 60 and retiring at age 60. And then on the right-hand axis is we've got the monthly income required. And you can see the light blue area, shaded area, that is your investment value. That's kind of going up to start with and then going down, generally around, around the age of 80, it starts to decrease in value. And then we've got what looks like a set of stairs going up, which is your monthly spending or your monthly income in that dark blue line. So we've got 50,000 Rand a month as being what you're going to draw to start with. And as you can see, that 50,000 Rand a month is going up, 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 up for about 21 years. It gets to around 135,000 Rand, which is in today's terms. And that is when this liquidity constraint comes. So what is happening there is, if you remember earlier, I said you can draw between 2.5% and 17.5% per year. Now, what happens in a living annuity is, as your investment's going, you can see you don't have any trouble in terms of longevity for quite some time. Your investment is growing, and it's growing comfortably. Your money's gone from 10 million over and above 10 million, and it's kind of stayed around the 10 million Rand mark until around 20 years into retirement. Now what's happening is your income has gone up and up and up. From a starting drawdown of 6%, it has now hit a drawdown of 17.5% in this example. So you now have hit your maximum income percentage that you're allowed. And because that income percentage is now at an unsustainable level of 17.5%, and your investment is only growing at 9%, you are drawing more than you're earning. And that's why we see this sharp decline in income over the coming sort of 9 or 10 years in this example. So when the individual gets to 90, they still have money in the living annuity. We can see the balance is probably around 4 million Rand at their age of 90. But they've had 9 years where the income that they were able to get has decreased. So that's, I think, a reason why when we give on the previous slide those guidelines, and I know for a lot of new retirees, they think that what they can draw sounds low. This is a good explanation of the concept around that. It's not too much about you being able to earn more than you spend now, but it's about being able to keep up with inflation over the longer term. And that's why obviously getting an inflation beating investment return is important, and keeping track of your spending is important.
Yeah, Stuart, can I just chip in?
Sure,
it's a great graph there. I just did a quick calc that, when you get to 90, 30 years on, that 60,000 that you're drawing in today's terms is about 10,000 Rand a month. Yeah.
So if you had to take 30 years of inflation, the buying power of that 60,000 Rand in the future would be equivalent of 10,000 or so now. So, yeah. Hence the importance of managing that your income can be sustainable, till these later years in retirement. Yeah. Thanks, Nick. So we've just got one slide on tax and then one slide on estate planning. Quite straightforward, nothing too complex. So as I said earlier, the income that you do get paid out, whether that's monthly, quarterly, half yearly or yearly, that's paid to you after tax, like a salary is. The income is disclosed to SARS. SARS pays you earn tax from that, and you get the after-tax amount. The nice thing about retirement funds, and this is all retirement funds, is they're obviously very tax-friendly on growth. So any capital gains you make and any interest you earn is tax-free. So, if you're investing in your own hands, obviously it can be a little bit more flexible of taking money as you like, when you like, but you're going to pay tax on your capital gains and your interest. So that's where retirement funds are friendly. Tax-friendly is that the growth and the interest is tax-free, and you're only paying tax on the income that you're drawing. Just 1 or 2 tips, and obviously we would be able to assist everybody with this on a case-by-case basis, is to pay attention to the portfolio composition. What you're investing in a living annuity is important. And I think the sort of chart I showed you on the previous slide, one needs to manage that they're getting a good enough investment return to keep up with inflation and keep their spending up with inflation over the long term. Use a living annuity as part of a holistic plan. I'm a big believer in this. I see a lot of individuals and new retirees that just want to see their pension as a separate thing, and just plan for that in isolation. Obviously, if the pension is 90% of your investable assets, then I can understand that. But where it's you've got a pension and you've got offshore money and you've got other savings in unit trusts and shares, I really don't think you should just plan for your living annuity in isolation. It needs to form part of a plan, because all those different investment accounts can really work together well to make your money last longer. Because ultimately, when you're more tax efficient and you pay less tax on your income, that means that you're drawing less from your investment, because paying more tax means you need to draw more to pay that tax. So doing the financial planning and the tax planning, can really add a lot of longevity to one's plan. And this is just be aware of tax tables and changes in the tax tables. So as we know, the government does a budget speech in around February every year, and then the tax tables generally will go up in March. If they don't go up, sometimes they stay the same. Like this year, the tax tables stay the same. But as we all have a little increase in income, we end up paying more tax on that income, even if the tax table stays the same. So I know a lot of investors of ours, when they're drawing a pension, and then March comes around and suddenly what they have in their bank account is a few £100 less, and they're thinking that something's happened to their investments. It's just that the tax tables have changed. So just be aware, every March is when the new tax tables, if there are changes to the tax tables, will be implemented on one's salaries and income. On estate planning, so as I said earlier, you can nominate beneficiaries. You generally can just nominate a beneficiary or a combination of beneficiaries. And with a living annuity, what's nice is that the beneficiary nomination is binding. There are no trustees that are going to go and do an assessment of who your dependents are, and because what happens in pre-retirement funds is that the trustees can overrule your beneficiary nomination. That can't happen with a living annuity. So whoever you say you want to get your money, they will get your money. It's a binding beneficiary nomination. And you are able to nominate a trust as a beneficiary, and there are some good cases where this is the right thing to do. If you want to leave money to someone who you don't want them to be able to just spend all the money quickly, then you can use a trust to inherit that living annuity on behalf of the investor, and the trustees of that trust would then obviously look after the beneficiary or beneficiaries. So it's a good thing for minor children or adults, family members who you don't want to just give the full amount of capital to. So on the passing of the investor, the beneficiaries, they can each make an election at that stage of how they would want to take their portion of the benefit. So they can take it as a cash lump sum. They can decide, I want to move the money to a living annuity in my own name and have an income for the rest of my life, or they can do a combination. So they can take a part of it as a cash lump sum and part as a living annuity. Like we do when we retire and we take money from our retirement funds, there's tax if you take it out as cash, and that tax is up to 36%. So it is quite a high tax rate if one is intending to withdraw it all as cash. It's higher than estate duty. Estate duty is 20% or 25%, depending on the size of the estate. So 36% is quite a lot higher than that. If on the other hand, the beneficiary chooses not to take it as a cash lump sum and to move their portion of the benefit to an annuity in their own name, then there's no tax on that transfer. That is seen as a retirement to retirement transfer, and the beneficiary will ultimately then have their own living annuity and get their own income from that. It's important to note that as a beneficiary, you don't have to be 55 or over to inherit a living annuity. You can inherit a living annuity if you are a minor, if you are still a working individual. You can have a living annuity as a beneficiary if you're under the age of 55. Okay, so just I'll wrap up before we go to questions. And this is more general retirement planning than living annuity specific. But we've just got 2 slides, and I think we just want to give some guidance of what sort of things we think are really pressing for individuals at this stages of their retirement planning. So if you're planning for retirement and maybe you're 5 or 10 years out from retirement, and you're trying to get your head around, do you have everything structured correctly? Are you contributing enough to your funds? What sort of income will you be able to draw? I think it's enormously beneficial to have a comprehensive retirement plan. I mean, that's obviously what we do here at Investonline, is we do these retirement plans with new and existing investors. It's a real nice roadmap to work on and go back to over time as things change. Review your investment portfolio, check that you have the right level of risk for where you are in your journey, that you don't have too much risk or too little risk. If you're still working and paying into your funds, it's very important to consider your investment contributions and which accounts you're putting your money into. There's a lot of investors who are putting all of their monthly contributions into pension funds. And as you saw in that earlier chart with that big liquidity constraint, is that you then can be restricted of not having enough flexibility and liquid money when you retire. So considering that and weighing up all your options, I think, is important. Don't ignore the importance of liquidity and flexibility. So with that, I know as investors, we all want certainty, and there's a big trend in the country of people wanting to invest in 5 or 10 year sort of policies or fixed deposits because they feel like the outcome is certain. What you give up when you do that is giving up being able to move your money quickly, buy assets when there's opportunities, sell assets when there's risks. And obviously, over the last 5 years, we've seen interest rates have massive ups and downs, where depending on where you locked in your money, you could be locking in at a good time or bad time. So we just think flexibility is very important. What we can do for you if you're close to retirement is we can do tax simulation with SARS to see how much you can draw from your investments and what sort of tax you're going to pay. And if you are married and you do consider your finances as joint finances, it is, I think, important to do a plan as a married couple and consider how you can split your money to be more tax efficient. As I said earlier, the less tax you pay, the more your money can grow because you're drawing less from your money from your investments to fund that tax. And then if you're already retired, the top 2 points are the same. As I still think a retirement plan is very important, and to review your investment and your risk. I think it's always important to really understand what you invested in and what the level of risk is that you're taking. I think reviewing your plan once a year, if you saw that chart earlier and how, that investor at age 75 would have been feeling very comfortable and you had to fast forward 5 or 6 years, how suddenly there was a big liquidity problem. If you review your plan annually, even if you are retired already, you can kind of foresee those issues that may be coming way ahead of time and you can make changes. Keep a record of your budget. I know this is difficult to do, but these days with online banking and bank statements, it's just to have a bit of an idea of what your monthly spend is. It really helps when planning. Try and monitor your inflation. And then don't ignore other expenses, what we call lifestyle expenses, which are things like buying a new car every 5 or 7 or 10 years, going on holiday, any family events. Often those are ignored when people do retirement planning, and I think it should all tie in together. So finally, and Nick will jump back in now, this is an example of our financial planning model. This is just an absolute sample that we've done. So in this model, you can see this individual is pre-retirement around age 60, planning to retire at age 65. What we do is we capture all of their investments, their contributions, how much they want to spend, their properties, etc., etc. The model knows how everything is taxed. It knows the investment growth of all the different assets, and it models the growth pre-retirement and then how long your retirement picture is expected to last. So in this case, if you can see the lighter blue area, this person's retirement plan was only going to last until about age 85. In terms of how that person had structured everything. once we do some tweaks and we make some suggestions and maybe change a few things, we're able to prolong that plan to age 90, which is that darker gray or darker blue area, where there's two different charts here, basically over one another, and we were able to extend that retirement plan by about 7 years. So that's just an example of our model, and we love to do that with our clients and new clients as well. So cool, Nick, that's everything from me.
Okay, good. Yeah, well done, Stuart. Thanks. Before I get into some questions that have been sent to us, just to remind everybody that this has been recorded. You will be able to see a recording of it on the website. Also, all our details are there if you want to get hold of us. Also, you can go back and look at our previous offshore webinar that we did if you just need some updating. Right, Stuart, a few questions. One is, can I move my living annuity to another provider or investment house? Probably pretty topical, given what you were saying about there being some restrictions on offshore at some institutions versus other institutions which still have full capacity. Can you make a move?
Yeah, so it's a good question. Obviously, it's become a thing over the last 2 years with the rand weakening that some companies are at their institutional maximum offshore. So absolutely, you can move from one investment company to another. I know a lot of people think if they take their pension out with one company, you can't move it. If it's a living annuity, you can move that investment. There's no tax implications to move. Generally, there's no cost to move. And, you know, it's quite a straightforward transfer. Your income will remain the same. Your anniversary date remains the same. It's really just saying, I want to move my account from this company, and for whatever reason, whether it's fees or offshore exposure or service, I would like to move it to another company. And you can do that. That generally can take a few weeks to a month for that transfer to take place, Nick.
Okay, good, thanks. All right, another one. I'm immigrating. Can I take my living annuity offshore?
Yeah, so no, you can't actually take a living annuity offshore, directly offshore, meaning withdraw it and take it with you out of the country. A living annuity is a South African retirement vehicle. It's governed by the Long-Term Insurance Act. So what you do, and we've got clients that have decided to pack up and leave and, you know, move overseas, is the investment will have to stay in South Africa. You can, however, invest that money all offshore in the investment. So you kind of would get out of, you know, being tied to SA specific risks. And what we would ordinarily recommend for those investors would be to take an income maybe annually instead of monthly, or biannually instead of monthly. So no, you can't actually pack up and leave with the money. I mean, just for interest's sake, for a pre-retirement fund, such as a pension fund or a retirement annuity, the rules there are very different. There you can cash in your fund if you formally immigrate. However, the rules are quite strict. You have to cease to be a South African tax resident, and only 3 years after you cease to be a South African tax resident are you able to apply to withdraw your funds. And obviously, if you cash in your funds, it's fully taxable up to that 36%, like that tax table I showed earlier. So it's generally not very easy or tax efficient to draw your funds pre-retirement either. So I think a living annuity, the best way to do it is to invest the money offshore and just to take lump sums out of it in the form of annual or biannual income.
Okay. And that would be investing it through asset swap funds.
Yeah, asset swap funds or feeder funds. That would be, so rand denominated funds that then feed into the offshore assets overseas.
Okay. Right, one more here is, can I move my retirement funds to my spouse?
No, so retirement funds are individual, unless there's a divorce order or something like that. Generally, if I've contributed to a retirement fund, I can't then at retirement or pre-retirement chop that up and give it to someone else, even my spouse. So it's a good question. A good thing if you are still saving for retirement and you do have a spouse who you want to have their own retirement income is to start a retirement annuity for them early. I think it's an excellent idea is to, instead of splitting the assets at retirement when maybe one individual has the bulk of the assets and the other individual doesn't have many retirement investments to their name, is to rather start a retirement fund for the spouse earlier. So then you can split the income in retirement. But yeah, in summary, no, you can't transfer an existing fund to a spouse.
All right, thanks, Stuart. Right, well, that's we're going to wrap it up here. Thank you for joining us. And again, if you want to see a recording, go onto our website. Obviously, it's investonline.co.za. Our details are there if you want to contact us. And yeah, thank you, everybody. Hopefully, this added some value to you. Bye-bye.
Thanks, everyone. Bye-bye.